As a part of considering an organisation's cash management, it is useful to calculate and analyse the operating cycle and cash conversion cycle. This is particularly important information when looking at an organisation's liquidity. Liquidity is the ability of an entity to meet its short-term obligations using assets that can be readily or easily converted into cash without losing much of their value. Woolworths Limited is a large retail company in Australia, operating supermarkets and hardware stores. Because it primarily operates retail stores, a large proportion of the value of its current assets is inventories. At the end of the 2015 financial year, Woolworths had current assets of $7.66 billion. Current liabilities were $9.17 billion, and the value of inventories was $4.87 billion. The current ratio gives us an indication of the organisation's ability to meet current liabilities using current assets. Using the information provided, we divide current assets of $7.66 billion by current liabilities of $9.17 billion, which gives us a current ratio of 0.84. This indicates that Woolworths could not meet all of its current liabilities at this time using current assets. This is not necessarily a bad thing. In this case, it is likely that Woolworths is using its cash funds for its operations rather than having it sit in accounts receivable or as cash at bank. The quick ratio breaks this down further to give an indication of the organisation's ability to meet current liabilities using the most liquid of assets. That is, those that can be quickly converted into cash. Therefore, to calculate the quick ratio, we subtract inventory from current assets before dividing by current liabilities. So taking inventory out of current assets in this case, we get a quick ratio of 0.3. You can see from these high-level liquidity ratios that working capital management and access to other sources of funding will be very important for Woolworths, as it cannot simply meet its current liabilities using current assets. We also want to consider free cash flow. This represents the extent to which cash generated from operations can be saved after taking into account capital expenditures. Ideally, the result would be expected to be positive. In periods of high capital expenditure, the result may be negative. Such results should only be evident every few years relative to the nature of capital investment planning. We work out free cash flow by taking net income, adding back depreciation and amortisation expense, deducting changes in net working capital, and then deducting capital expenditure. For Woolworths, we work out that free cash flow is $2.14 billion, indicating that Woolworths has a healthy amount of cash remaining after accounting for capital investment. From these ratios and the free cash flow calculation, we can get a good idea of Woolworths' cash management. It is fairly clear from this information that Woolworths actively manages its cash flows by holding low inventory values, collecting accounts receivable quickly, and extending supplier payment terms to enable the use of cash from operations to pay for these supplier accounts.